so in love with you.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to talk about how a recession would actually help the housing market. So there's a really good article I'm going to go into from Insider that's going to talk about exactly that. And I could tell you guys, based on my own personal thoughts, I think one thing that will actually unfortunately help the housing market and basically the reset, the crash in prices is, unfortunately, you guys, unemployment. And unfortunately, you guys, that's part of the effects of a recession. So we'll go into all of that today. And just remember, you guys, I'm not a financial advisor, even though my bio is as a doctor crash brother, even though my bio is as someone that wants to empower my viewers. Not only empower my viewers, I want to make you guys teachers yourself on basic principles like wedge, cash flow, purchasing power, how to do a market analysis, credit, income, assets, and all of those things. So not only do I want you guys to evolve and improve, but I want you guys to make other people aware just like you. And for all of that, guys, if you can, like this video, subscribe if you haven't already, and shoot me a comment below because I need to hear from you. The name of this article is "A Mild Recession Could Actually Be Good for the Housing Market." So 3 bullet points I'll cover before jumping into the article. And also I'm going to show you guys the 2 and the 10, look at Case-Shiller, and we'll also look at unemployment. But the first bullet point states, Wall Street firms have eased recession calls recently, but a mild downturn may actually be good for the housing market, and it will be absolutely good for the housing market. Bullet point number 2, a recession would likely push the Fed to ease monetary policy and mortgage rates would fall. And we don't want mortgage rates to fall too soon. We understand that the Federal Reserve is in control. We understand we're in this situation because of the Federal Reserve. We also understand that this would be a federally induced recession. So it's especially important to understand that, and especially important to understand that we cannot have rates go too low too quickly. A mild recession could also bring down home prices as supply becomes available. I have been doing research on the amount of home sellers on the sideline, and there's a ton. There is a legit ton of people that want to sell their house right now, but are waiting for low interest rates. And here's the thing, guys. So if the premise is by dropping rates to around 5%, it's going to have a huge influx of supply, that's okay so long as there's enough credit tightening to stifle demand. A downturn typically hurts the economy across the board, but a mild recession could actually alleviate some of the recent pains Americans have been feeling in the historically expensive, competitive housing market. For many Americans, buying a home hasn't been affordable since the pandemic, with mortgage rates hovering near 7%. Current owners are unwilling to part ways with their low interest rates they secured previously, exacerbating the home inventory shortage. In June, the median sales price for the typical starter home reached an all-time high of $243,000. And in August, Goldman Sachs Housing Affordability Index hit a record low. And this is the affordability index right here. This is going back to 1997, and unaffordability has never been this bad going back to 1997. It got close during the Great Financial Collapse, but it's worse right now, you guys, than the Great Financial Collapse. The difference being that people are still paying their mortgage right now. And again, you guys, the main catalyst during 2008 was people stopped paying their mortgage. Whether it was a fixed rate, subprime, prime, people stopped paying their mortgage, unemployment became unhinged. Looser Fed policy. The Federal Reserve's aggressive policy tightening campaign has kept many homebuyers sidelined, with 11 interest rate hikes in the last 18 months. In a mild recession scenario, however, central bankers would likely start moving in reverse with rate cuts, which could lead to lower mortgage rates and more affordable homes. Again, but if that happens too soon, it's going to be pure chaos. To be sure, home buying demand could increase if the Fed cuts rates so swiftly that mortgage rates see a rapid decline, and that's not what we want. A flood of home buyers looking to capitalize on lower rates could end up keeping prices elevated, and that's the scary thing. When Jerome Powell last spoke, he finally mentioned that inflation is being held up by the housing market. And if he can't get control of the housing market, more changes and tightening is coming. That's great news. Talking about home sales. In a recession, some Americans would lose their job as unemployment rises, which is really the hit we want to prepare for, which could lead many to sell their homes and face foreclosure. More available supply for house hunters could bring list prices down and minimize bidding wars. It's worth noting, too, that homeowners today are more financially resilient than in 2008, a time when anyone can secure a mortgage. This could help buoy home values enough to prevent a dramatic crash. But avoiding a recession entirely would likely keep home demand strong and inventory tight, meaning the markets remain unaffordable. So again, the thing we're missing here, you guys, is the unemployment, and I hate to say that. LendingTree's senior economist told Insider in a recent interview that the supply and demand dynamics of the current market are distorted, but it's possible demand surges if mortgage rates dropped to about 5%. On one hand, more demand puts upward pressure on home prices, he said, but housing supply has decreased significantly. And that's also because it's become more costly to build and harder to get materials. But now supply chains are better and raw materials are decreasing in price. So we have two possible forces. Demand could come back as rates decline, and supply could improve as building comes back. And right now, it should be no surprise that there is a ton of new home building going on right now. One thing I want to do is jump into the inversion of the 10-year and the 2-year, because this inversion is a historical precedent for an incoming recession. And you guys, right now, it is screaming to us, caution, caution, pain incoming. This is Fred economic data. You guys can see that we've been inverted for a slightly over a year. Now, the average time of inversion is 15 months before we hit recession. And we've been there again, you guys. I think we're now in our 13th month. The inversion is basically when the blue line goes under the black line. Now, when I max out this chart, let me max this out for you guys, okay? We can see here, let me move my picture as well. We see here that during the last 4 recessions, this uninverted and then recession. You see that? Uninverted, recession, uninverted, recession. But I also want to point out that this does not necessarily have to uninvert for us to go into recession. And we saw that in the late 70s and early 80s. You guys can see that we were still inverted while in recession. You see that? We were still inverted here and we were in recession. Nevertheless, this is telling us we need to be cautious when investing our money. Now, one of the big issues with investing our money in houses right now, because a lot of people make the argument that housing is a great hedge against inflation, which is generally true. But the problem this time around, you guys, is this. This is the Case-Shiller U.S. National Home Price Index. And quite frankly, what I want to point out, you guys, is the unprecedented, unsustainable, fundamental breaking equity run up right here. And essentially what this shows me is there's just no room for values to continue to go up. We've already seen values break seasonality and decline sharply. Now, recently there has been a rebound, but nevertheless, you guys, the reason I believe this time it is not a safe investment is because they've already squeezed out all of the value. And to put it in perspective, look at this bubble. This is the bubble from the Great Financial Collapse. The asset bubble we have right now in our housing market is bigger than the last great financial collapse. Now, arguably, the biggest pain from recession will be unemployment. And I want to point out also that it's very intriguing that unemployment rate and mortgage delinquency rate actually coincide with each other. So when unemployment goes up, mortgage delinquency goes up. And right now, with all of the economic turmoil, with all of the pain, remember, we haven't started the recession. And unemployment hasn't even started going down yet. Take a look. Here's the unemployment rate right now, you guys. We're sitting at a historically low 3.5%. What this demonstrates is unemployment has gone down since quantitative tightening. What does that mean? What that means is the market has not yet, as Jerome Powell has stated, has not yet felt the pain. And it's especially important to be patient because there are massive lag effects. And generally things lag and lag and lag, and then they explode and become unhinged. And I want to point out how unemployment becomes unhinged leading into a recession. We can see that here during the great financial collapse. Unemployment went from the 4% all the way up to double-digit unemployment. This recession here as well went from 3 to almost 6%, but you can see the trajectory explodes, you guys, absolutely explodes in pretty much every single recession. Now, what does all of this mean to you if you're on the sideline waiting to purchase a house? To me, what this means is we need to make extra special sure, never been more important, that number one, we have great spending habits and we are in a situation to where we can save money and we have no consumer debt. Another very important thing is to make sure we do everything in our power to make sure we don't lose our jobs, okay? Because when it's unhinged, it can literally hit each and every one of you. So I want you guys to make sure you have your resume, you're working hard at work, and right now, while we still are employed, we're working our overtime, we're getting our bonuses, and we're working extra hard to make commission. Now, other than that, guys, I really hope this video allowed additional perspective. If you're losing control on the sidelines, if you're getting impatient, these things, understand there's a reason why the saying goes, patience is a virtue, because it's not easy. But I'm here to say enough with the obsession over purchasing real estate, because right now it's hard to justify any benefits in purchasing. And again, that's just my opinion. And other than that, guys, I really hope you guys got some new insights, value, and perspective. And if you're out there investing in real estate, you know I wish you luck and I hope you win.